Well, hello everyone. This is AJ Brown with a company called Trading Trainer, and I've got a very special presentation for you this evening. It's called The Only Four Strategies You Need for Making Serious Income Even When the Market Takes a Dump. And there's a lot of folks out there, when we talk about the divergence of the economy with Wall Street, which happened about 11 years ago, if you remember. And when that happens, there's a lot of uncertainty in Wall Street. When there's no basis for what people are investing in, there's a lot of uncertainty. And you can see that if you look at implied volatilities, if you look at volume, if you look at kind of the stall. And at some point, well, a lot of folks feel like the market might take another dump just like it did back in February. So how do we make sure we can keep our income flowing? That's what we're going to talk about this evening. So without further ado, let's get right into it. I'm also going to be giving you some tickers that you can follow on your own after this presentation just to see how everything works out. So like I said, what's happening in the world right now, it just kind of sucks. But what's happening in the markets, especially if I teach you how to play it right, it's going to set you up for months, if guys, I apologize. I keep unmuting myself and then I keep getting muted back. And I don't know what's happening here, but I apologize. So I don't know how much of my presentation is getting through to you. Can you do me a favor? Take a look at your webinar control panel. Find the orange button with the white arrow on it. And below that button, you're going to see a vertical column of buttons. At the bottom of your vertical column is a hand raising button. Will you all just show me, because I have a whole list of you here on my screen. I'd love to see if you're paying attention. Will you click on that hand raising button? I've got a column with all your names here, and I can see when you put your hands up. And if you click your button again, put your hands down. All right, fantastic. So I may ask you to put your hands up and down over the next presentation minutes just to make sure that my voice is coming through. Is that fair? Good, good. The other thing I'm going to suggest as well is that, remember I directed you to that orange button with the white arrow on it. Whether you're seeing us in a computer or you're watching us on a mobile device, find that orange button with the white arrow, click it, and what it's going to do is it's going to squeeze the webinar control panel off of your screen, and that way you'll be able to see more of my screen. It's going to free up valuable screen real estate. All right. So Again, I apologize for going in and out. I'll try to keep my eyes on that microphone button. I'm not sure why it keeps muting me out, but I'm going to keep my eyes on it. Also, people are saying that I'm breaking up. One more time, I'm going to put all your hands down. How many with the show of hands can hear me loud and clear? All right. Just about everybody's hands are going up. So if you're still having problems hearing me, it might be on your system. Okay, boss? Okay. All right, fantastic. Now, I am going to go ahead and have the Q&A area open on my screen, but it is a bit distracting. So here's my promise to you. If you type in a question, a trading question, I will make sure before I leave the presentation tonight that I go back through all and answer all your questions. So I ask that if you're typing in messages, that you reserve them for questions about the trading content, okay, about the content I present. I'm not interested in saying hi to you, even though that is nice, but I want to get a whole bunch of lessons through to you. And also, I'm not interested if you're having computer troubles, because that's also, again, I'm here to make sure I make your lives better. So you got to just keep up with me, all right? Because we're going to go Mach 3 with our hair on fire. So let's get into it. Like I said, a lot of us are being forced to take off time. So let's use that time to profit. Let's not use that time to lose right now. So let's keep going here. So I want to explain to you, because I've been teaching at Trading Trainer here since 2003. And so I've had a chance to watch thousands of folks get through, and I've really nailed down investors' errors to 2. How many with a show of hands want to hear? Let's start from the bottom. The second most common error that investors make, because I'd like to share it with you, because I'd like you to write it down, and I'd like you to make sure you never make it. And if you've already made it once, don't make it again. So here we go. The second most common error that investors make is that first we have to recognize patterns. And people have often said to me that, AJ, you are just amazing at recognizing patterns. That is definitely something that's learned. I mean, I look for everything. I look for anything that has changed. Here's going to be something really funny. When I walk out to the car, I'll walk past the electrical meter for the house, and I will know, did we run the dryer? Did my wife use the hair dryer? Because all of those things use a lot of electricity. So I want you to become uber open to recognizing patterns, especially when it comes to investing. So patterns in price, patterns in panic and fear versus confidence, pattern in time. Then, second, we use the tools that we have to profit from the patterns we recognize. So I ask my folks to first be pattern recognition specialists before they become pattern utilization experts. Why is that? Well, here's a common thing that folks come up to me and say. They say, AJ, I learned how to invest using, and fill in the strategy. Let's just pick one, uh, credit spreads. And I was applying credit spreads religiously, month in and month out. Every time options expired, I did the credit spreads, and I was making close to double-digit returns every month. And then something happened on the 10th month. I wound up giving back all the gains I made in the first 9 months, plus half my portfolio. That was an example of the second most common error investors make, right? Because what is a credit spread? It is a way to profit from a pattern you recognize. It's not the end all to be all tools. It's optimized for a certain pattern in price, in panic and fear, and in time decay, right? So if you apply that tool at the wrong time on the wrong pattern, well, it's a fast way to suffer trading loss. So I want you to get in the habit of first understanding what you're investing on, and then look for a strategy to profit from it, not the other way around. Don't learn a strategy and then apply it willy-nilly all the time, hoping it will always work, because it may work if the pattern is working in a certain way, but if that pattern changes and you don't pick up on that pattern, then you'll apply the same tool and it'll be a way for you to really suffer some heavy trading losses. Okay, so first we recognize patterns. Second, we profit from those patterns by picking the right tools to do so. So that's the second most common error investors make, is that they learn something. They learn a strategy. They learn how to profit from Forex. They learn how to profit from options in only one way, and then they try to apply that to every pattern that goes by. You guys want to know about the first most common error investors make? I don't really cover this in this presentation, but would you like to know it anyway? If so, raise your hand. All right. We only invest the amount specified when we take our max allowable risk to our portfolio and we divide it by the maximum trade risk that we came from preparing our trading plan. It's a mathematical formula. Let's go back to that example of that person who came up to me and said, and in fact, it's not one person. If I had a nickel for every time somebody came up with a similar story about, hey, AJ, that was a great presentation. I learned how to XYZ and I applied it every month. And it was working like clockwork, but something happened on month 10. And I wound up not only giving back all the returns I made on the first 9 months, but I wound up losing half of my portfolio. You can tell right away that that investor not only made a mistake on their pattern recognition versus pattern utilization, but you know they also didn't do good risk management. A lot of the reasons, the follow-up question I'll ask is I'll say, now tell me, how did you lose all the gains you made in half of your portfolio? What were you using for position sizing? Number one answer. When I first started this strategy, I was new to it. And so I only invested a small amount of my portfolio, but each month I got more confident. And by the month 10, I was investing half of my portfolio into some of these investments. Oh gosh. If only the market cared about how confident you were, is what I want to say, right? That's in my head. The market doesn't give a flick how confident you are with the strategy you're using. That gives you no right to change your portfolio sizing or your position sizing based on your confidence in a strategy. That's not how we do it. It's a simple mathematical formula, right? You take your position sizing, and that equals whatever your max allowable risk to your portfolio, and you divide it by whatever the trade risk is. And that's always going to be your position sizing. Your confidence in a trading strategy means nothing to the market. The market doesn't care about you. Simply apply this formula and you will always be in a good place. The other excuse I got once was, I had lost for like 1 or 2 months before I started using this strategy. So I had to make up the gains. Folks, the market doesn't care how much you've lost. They're not going to say, oh, you know, Trader Mark or whatever, Trader William, Trader AJ had some losses. So this time we're going to make sure. Don't size your positions based on how much you need to make up in your portfolio. Again, it comes down to this formula. It's a mathematical formula. Apply this mathematical formula, you'll never go wrong. Another one I got once was, well, AJ, my wife needed a new car, so I was investing enough to buy a new car. Or one person said, I was investing enough to get a new couch. Or I was investing enough so I could pay this year's tuition for my daughter to go to college. None of those reasons does the market care about. So the first most common error that investors make is that they don't have proper risk management. If they only did position sizing equals max allowable risk divided by maximum trade risk, they'd always be safe. So those are the two most common error investors make. I'd like you to make sure you have those written down. How many of you with a show of hands have ever, and it's okay to be, a little moment of honesty here. Have you ever had these happen to you? Yeah, a lot of hands are going up. That's fair. That's fair. We've all done something like this, but now that I've pointed it out to you, I don't want to see you do that ever again, especially if you decide to wind up working with me. How many of you, I could skip over these slides. These are slides about who I am. How many of you with a show of hands actually have an idea who I am? You've heard of me before? Okay, cool. Well, let me ask the opposite question. How many of you, let me put your hands down for you. How many of you with a show of hands have never heard of me before? Oh, all right. I've got 3 slides here. I'm going to rush through them. I founded a company called Trading Trainer. Folks recognize me as the world's most disciplined options trader. I think behind my back, they call me the world's laziest options trader. I think I would rather be called the world's most efficient options trader. And that's because I like to spend as little time in front of the computer screen as possible. That's right. I like to spend as little time as possible in front of the computer screen. Rather, I also like to spend as little amount of my dollars to get as most of my return. And I also don't like those times where you wind up getting either wound up positively because you have some good trades or wound up negatively because you've had some bad trades. I like to keep my emotions even keeled. So you'll notice that I am very efficient in what I do. And I am very, very to the point. In other words, I spend 35 minutes every evening looking for symbols, doing my planning, doing my risk management. I pre-program in what's going to happen into my conditional order entry rules, and then I'm done. I have my day free the next day. I come back in the evening, I see what my trading platform did for me, if anything, and I just look at what my positions are doing, and I just collect incomes. I've been doing this since 1997, and I started my trading trainer school in 2002. I've been publishing daily insights for those folks every night, 5 days a week. Also, you might have heard of my ebook. A lot of folks have that on the computer. It's called The 7 Strategies of Successful Option Traders. I also have a very popular home study course that's on a whole bunch of people's shelves. And the most important thing is my foundation. 2003, I took 9 inner city gangbangers off the street to teach them how to invest. Now, this was when I lived in Denver, Colorado. And what's cool about this is this was in a kind of a rough area outside of Denver in a place called Aurora. We met at the public library. Now, the public library in 2003, the fastest internet connections we could get, if you remember back to 2003, was DSL. And the library limited us to half an hour a day on the computer. So, and these kids were in high school, but I'll tell you, none of them had passed a 10-year-old or fourth grade education. I feel like the school system was trying to push them through. So I took these kids, put them through 6 months of training with me. We only had half an hour a day on the computers. And at the end of the 6 months, I gave each of these 9 kids $2,000 of my own dollars, thinking I'd never see that $18,000 again. And I'll have you know that each one of them paid me back, and they all wound up buying themselves their own computers and their own high-speed connections into their homes. One of them actually put himself through Denver University, and he's now teaching finance. So I'm very proud of these folks, and I've actually been running this foundation ever since. Every year we get a little bigger. 2019, we graduated 170 kids. We've also moved this foundation from the Denver area. It's now based in Chicago, where we can cater to the South Side Chicago folks. You hear about that a lot, where there's a lot of kind of poverty down in the South Side of Chicago. And we've partnered with the Chicago Board of Options Exchange to deliver this. So this is my passion. Reason why I tell you about this is because if you ever call anybody here at Trading Trainer, what's neat is none of us make money off of selling education to folks like you. And that's very different than what happens out in the market these days. If you hire a trading guru, if you buy a program from somebody, you might take a moment and think about how many other people have bought programs from them and how much you spent, and realize that they're probably making more money on selling education to you than actually trading. Everybody you talk to when you call Trading Trainer's 1-800 number is a trader. In fact, we have to trade in order to have our families have food in the evening. So you'll always be talking to a real life trader, not somebody who used to trade or even somebody who's never traded, which is often what you might find at some of these schools. So something to think about, because we give all of our money to this foundation. We also give a lot of our time, all my coaches and I. Okay, so enough about me. Let's get into some of this discussion. Now, I always like to do this comparison in the beginning because I like you guys to really wrap your head around some of these concepts. So if you've had this before, just humor me. Which would you take right now? $50,000 or a penny that doubles every day for a month? Let's go through the math. All right, if I'm taking the penny, a week in, I've only got 64 cents. I'm starting to regret my decision to take the penny because I'm already about a fourth of the way through a month and I don't even have a dollar to my name, but let's keep going. All right, it's day 10. I got $5.12. I'm about a third of the way through the month. And gosh, that's a lot of time that's gone by that I've had to put the work in to double this penny, and I still don't have anywhere near the $50,000. All right, let's go to day 14. 2 weeks in, I still have nowhere near the $50,000. 15 days in, I'm about halfway through the month. I have 163.84, nowhere near $50,000. And again, I'm putting in a lot of work and not seeing a lot of return. Day 20, I'm about 2/3 of the way through the month. Starting to see some money, but God, I've been working so hard trying to double my money, double that penny, and I've only got $5,242.88, just a little bit over 10% of that $50,000. 3 weeks in, I've got 10,500 just about. All right, as I go, it's on day 24. The month is almost over, and I finally have more. And then look what happens. I keep working, I keep doubling that penny, and by the end of the month, I have $21,474,836.48. Now, I'm not sure if Einstein actually said this, but what we've just demonstrated is called compound interest. Calls it the most powerful force in the universe. In fact, I'm going to show you this slide again because this is actually a investment of mine, and you can see how the compound interest is working here as well. But I don't want you to think that you can double, some folks will tell you, hey man, you can double your money on every trade, but they're talking about a trade that maybe happens once every, quarter or once every half a year. I want us to have consistent income. So if we reverse engineer that, please write this down. If you earn 6% on your money every month, your investment will double every year. Now, that's not continuous interest. That's simple interest. 12 times 1.06, your investment will double every year. So let's aim for the moon and maybe we'll get to the stars. All I really want you to earn is 6% on your money every month. Not doubling, not doing any of these crazy trades that folks will say you'll double your money consistently, because a lot of times those have so much risk, they're just not telling you about it. So if you had $1,000, you focused on the 6% per month, in 12 months, you'd have 2,012. In 2 years, you'd have 4,048. 5 years, you'd have close to 33,000. And guess what? 10 years, you'd be a bona fide millionaire. But that's not it. Don't forget that if you had a $100,000 portfolio and you focused on 6% every month, you would generate $101,219.65 every year. Now, that's more than the median income for a white-collar desk job. The difference is this is letting your money work for you versus working 60 hours per week, which is what that job actually entails. So, okay, what are we talking about? Let me test how many of you have been paying attention. What minimum returns must you make monthly on your portfolio to more than double your money annually? Please write it down on your piece of paper. Is it A, 0.5%? Is it B, 1.5%? Is it C, 5%? Is it D, 6%? Or is it E, 10%? If you wrote down D, you've been paying attention. 6%. So what are we actually investing in? How are we earning at least 6%? Actually, the folks in my program are earning somewhere between 11 and 14% right now. But what are we actually investing in? We're selling Theta Decay's optimized option premium. Write that down. Theta Decay optimized option premium. In other words, we're profiting on time passing by. As I said, when there's a divergence between what's happening in the economy, I don't know how many of you with a show of hands paid attention to the last economic numbers from last week. Economy, at least here in the States, is in the dumper. However, Wall Street, you take a look at the numbers on Wall Street, you would never know that. Big divergence. Federal Reserve is pumping it up, keeping it going. When you have that divergence, again, between economy and Wall Street, you get a lot of fear. You get a lot of uncertainty. You get a lot of confusion in investors. Also, directional moves are no longer as predictable. In fact, it pretty much becomes a crap game. So what can we do to profit consistently? Look at the screen. We're going to profit on time passing by. That's one of the most reliable variables we can profit on. I mean, if all of a sudden 60 seconds doesn't equal a minute, or a minute 60 minutes doesn't equal an hour, 24 hours doesn't equal a day, 7 days doesn't equal a week, 52 weeks doesn't equal a year. We got something bigger going on that we have to worry about than just making money. If time all of a sudden stood still, we've got problems. So this is reliable. So some of you are saying, what the heck does he mean by option premium? If you look up an option price, you're going to notice that it comes in two components. Every option price has an in-the-money value and it has a premium value. If you're an academic out there, you might be calling this the intrinsic and the extrinsic value. Sometimes as well, premium is called time value. I hate that name because it encompasses way more than just time. So I call it premium. So whenever you look at an option price, just know there's two components in there. Some of you are saying, I've never even really thought about options before. Well, what is options? Well, it's a financial instrument called a derivative, contract between a buyer and seller. And they're typically bought and sold to hedge risk against stocks, indexes, ETFs. But that's not how we're using them. We're using them instead to sell and make premium on that. So how do we do that? Please write down these 4 simple transactions. Covered calls. Covered puts, a very important one to know about, especially with what's going on in the market right now. This is where we flip the covered call upside down. What about writing a covered call against a leap, a back month option? This is, I often refer to as supercharging the covered call writing. For you academics out there, we can call this a variant of bull call diagonal debit spreads. And what about writing covered puts against leaps? We could do the same thing with puts. Again, that's supercharging covered put writing. Academics out there, you can call this a bear put diagonal debit spread. How many with the show of hands have these 4 written down? Excellent, excellent. Now let me tell you, 3 of these are cash trades. Writing the covered calls, supercharging the covered call writing by writing the covered calls against a leap. Also supercharging the covered put writing by writing the covered puts against the leap. And one of these requires a margin account. Now, why do I point this out? That's because I do this strategy in my cash-free, tax-free IRA accounts. Any of the cash trades can be done in your IRA accounts. I have all sorts of program participants who also do this. Why pay taxes on your gains if you don't have to? So it's important you mark that down in your notes. So let's take an example here. Now, I pulled the end of day prices from today on GE. GE is a pretty popular name. Look around your home, you'll probably find all kinds of stuff made by GE. If we bought some GE today, it's going for $6.14. Now, if I sold the GE $6.50 call that expires this upcoming August 21st, I'll make back 12 cents. Now, I'm going through a very simple example here. This is called a buy write. It's where we buy something and then write a call option right away. Just know that in my program, we actually leg into these positions. We put a little bit more finesse in it and we get higher returns. But I'm going to go through this simple example just to show you some of the basic returns, right? Something that you could wrap your mind around. So if I do this, a lot of you know that options are sold almost all the time in lots of 100 shares. So every time I sell one of those call options, I'm basically making an instant dividend of $12. So what happens if GE closes above $6.50 on August 21st? All right, let's go through the math. I paid $6.14. I get $6.50 for getting exercise. So I make 36 cents of profit on each share. In addition, I got to keep the 12 cents I made on selling the call in the first place. So I get a total profit of 48 cents or an 8% return on investment. Not bad. What happens if GE is flat by August 21st? That means time went by. I bought that stock. I sold that call for 12 cents. Time went by and I wound up getting to keep that 12 cents. In other words, that call acted like a coupon, right? Like when you get one of those Boy Scouts or something that comes to your door, or Girl Scouts, or any scout, comes to your door and sells you that book of coupons. You pay like $5, $10, and you get a book of coupons. If you don't use that coupon, what happens? It expires worthless. The restaurant basically made whatever amount that coupon was because you never used it, right? If you went to go purchase something from that restaurant or whatever the vendor was, that coupon would be no good. That vendor's now going to get full price. So it acts as kind of an expiring coupon. And notice as well, I'm also getting a discount on my underlying symbol, right? I bought General Electric and then all of a sudden I get a rebate on it. So if I make just the 12 cents, I make 2% ROI, and I'm going to do it again every time. It's called rolling out the option. Rolling every time it expires worthless, we're going to roll it out. Keep collecting those incomes. In fact, this is the ideal case. We'll try to leg into these positions so we can boost up the ROI above that 6% number, but this is exactly what we like. Okay, what if GE drops by August 21st? All right. So I got $6.14. Like I said, it's like I get a 12-cent discount. So there's what I call a profit buffer built into this. It has to drop by more than 12 cents. Otherwise, I'm still going to profit with gains, right? So there's a profit buffer built in all the way down to $6.02. Now, in a couple moments, I'm going to show you how we then use something called a married protective option to stop anything below $6.02. But even built into this strategy is a profit buffer. So that's cool. Here are some gains with some covered calls. 17% on Micron in 12 trading days when the stock went up, 15% when the stock treaded water, 14% when the stock took a big dump. Now, I've got a lot of these case studies in here, but I might go past them because I'm watching the time. I don't want to keep you any longer than I have to, but I want to check your understanding here. I want you to answer all that apply. So there's probably more than one answer. What does investing by selling premium create? Does it create an instant dividend? Does it create a discount on a security? Does it create a profit buffer? Does it act as an expiring coupon? What do you think? How many of those answers are correct? If you said all of the above, you're absolutely right. Okay. Some more gains, 21% on Caesar when the stock went up, 12% on St. Joe when the stock went sideways, 17% on Community Health when the stock took a dump. Okay, now I'm going to ask you a question in advance to see how much knowledge you already have. How can we lower our investment, increase our returns, and even convert a margin trade into a cash trade? Should we sell out in time options? Should we replace the security with options trading at parity? Should we just give up and buy some mutual funds? Or is what I'm talking about not even possible? What do you think? A, B, C, or D? Only one answer. If you picked B, that we're going to replace the security with options trading at parity, you're spot on. So you might be saying, what does he mean by options trading at parity? Well, option premium is most when the option is at the money. That's why when we sell our premium, we sell near term at the money options. But when we go deep enough in the money, the option has very little premium. In fact, trading at parity by definition, by strict definition, means there's no premium. It's all intrinsic or in the money value. What we like to do is we target that it has less than 5% premium and is almost completely intrinsic value. Please write that 5% number down in your notes. In other words, if we go deep enough in the money, the option behaves exactly like the underlying security, dollar for dollar. So for instance, if the stock goes up $1, the deep in the money call substitute will also go up $1. If the stock goes down $1, the deep in the money put substitute, well, it goes up $1. It's still $1, it just the put goes in the opposite direction. The cool part is we can do this. We can get something that acts just like the underlying symbol, but we can do it for a cheaper price. So far, how far out in time should we get these substitute options? Let me give you some statistics right now that you may want to jot down. These are from actual people in our program. It's not just me. These positions tend to last on average 5 months. Now, that is a very flat curve. That means that a lot of the positions last only 3 months and quite a few positions last as much as 8 months, even 9 months. The other cool thing is because of the low risk in these positions, typically in our participants' portfolios, it only takes 3 to 7 positions to vest your whole portfolio. Whether your portfolio is $800 or whether your portfolio, like some of our participants, is in the 8-figure range. We have a couple people with $12, $13 million. 3 to 7 positions. What's nice about that, if you think about it, if a position lasts 5 months on average, sometimes more, sometimes less, and a position, there's only 3 to 7 positions and your whole portfolio is vested and working for you, it turns out that we're only replacing a position with another position once or twice every quarter. So again, I told you I was a very efficient trader. I'm not day trading by any means. I'm just collecting the premiums every month. And if one position goes out, it probably will go out once or twice every 3 months. And that's when I put a new position in. And other than that, I'm just collecting my premiums. So with that said, come on back here to this discussion that I have. Let me just come over here and I want to, we're going to buy our back month option far enough out in time so that the substitute option expiration will not interfere with selling many cycles of premium. It's kind of like if you had a really nice rental property and you had some tenants in there and you wanted to make sure that you collected as many rents as possible. I mean, what would happen if like you had these perfect tenants, they didn't destroy the place or anything like a lot of tenants do, and like they had a year-long lease, but on month 8, for some reason, your property disintegrated. You wouldn't want that to happen. You'd want your property to last longer than your tenant's lease. So we go out as far as we can. So if the number is 5 months, maybe going as far as 8 or 9 months, then let's go at least 8 months out in time. In other words, let's perhaps use some leaps. Now you might say, which is more important, using a leap or going 8 months out at a minimum? Well, it comes down to liquidity. Leaps have a lot of liquidity, and liquidity will never do us wrong. So the real answer is 8 months. But we need the liquidity. So if there's no liquidity in, say, for instance, what's 8 months from now, maybe the March option. If there's no liquidity in the March option, then go to the leap. What would be the next leap after March? 2022. So it doesn't necessarily have to be a leap, but we tend to go to the leaps because of the liquidity. Please jot that down. It's an important point. Excellent. So let's find a substitute to our GE trade that's trading at parity. So GE tonight closed at $6.14. If we go with now in this case, the March option had enough liquidity, probably because GE is one of the bigger stocks out there traded. But if you had a smaller name stock, the March option would have like no open interest. So it's all about liquidity. So in this case, I'm going with the GE March 19th, 2021 $3 call. That's going to last me long enough to collect as many rents as possible. And instead of paying $6.14, I'm going to pay $3.28. If you do the analysis on this particular back month call option, it's got 95.7% of in the money value and 4.3% premium or extrinsic value. It's got a delta of about 0.97. All right, so $3.28 instead of $6.14. I still collect that 12 cents for the near term at the money option. Get my instant dividend of $12 per option contract sold. What happens if GE closes above 650 on August 21st? Easy. I paid $3.28. I get $3.50 because I get exercised at 650. I do some exercising at the $3 back month price, so I get to keep the spread. That's why they call this a debit spread, a diagonal debit spread. So I made 22 cents of profit there. I also got to keep the 12 cents, 34 cents of total profit, or an ROI of 10.8%. Not bad. But let's see what happens if it does what we really want it to do, which is just go flat. $3.28, 12 cents. I get to keep the 12 cents, 3.8% ROI so far. I'm going to do it again and again. Remember, if I leg into this, I can almost triple, if not quadruple these returns. That's well going to get me above my 6% per month. If GE drops by August 21st, I still get that profit buffer of 12 cents. That brings my break-even price down to $3.16. Don't forget, if we focus on that 6%, our investment will double every year. $1,000, 2012. 2 years, 4,048. 5 years, close to $33,000. 10 years, you're a bona fide millionaire. Just letting this thing run in the background. If you still want to do some active trading, by all means, take a small portion, do some active trading, but let these strategies work in the background, because you're not going to have to do any more than maybe check in with them every evening, see how they're doing, collect the premiums. If you want to trade weeklies, many of you know about the weekly options. you get a premium every weekend. If you do like I do because of the liquidity and do monthlies, well, then you get a premium every once a month, third Friday of the month. Don't forget, if you have a $100,000 portfolio and you want to start pulling money out, you could pull out more than what a median income, I apologize, get my statistics straight, median income of a white collar job, $87,000. All right, 43%, 9%. I think I have to tell you about the most important part. How can we drastically reduce our return on risk? Should we sell half as much option premium? Maybe we should sell out in time options. Maybe we should collar the investment by marrying a protective option, or is what I'm talking about not even possible? What do you think? Do you know the answer? Write it down on your piece of paper. By the way, if you get one of these questions wrong, I don't care. This is the time to get it wrong, because what's the worst thing that's going to happen? I'm going to give you the right answer, and then you won't make the mistake moving forward. It's called guided discovery. Enjoy it. So we're going to collar the investment by marrying a protective option. So let me actually show you two examples, and I'm going to show you. So we've been talking about General Electric, right? General Electric is the perfect stock to do this strategy with, by the way, because it likes to just go sideways, and so we can keep selling premiums and then have them expire worthless. But I want to show you one on Ericsson, ERIC. Now, Ericsson just in this last month popped up and it's in its new channel. But if I go back here and take a look at Ericsson over, say, for instance, the last 2 years, this is a 2-year weekly chart, you can see that I've been selling premium against Ericsson. Actually, I've been selling premium against Ericsson for almost 2 decades. Here's the scoop. I don't like companies to sell premium against, like Tesla or Apple or these type of companies that have a lot of volatility, have a lot of hype behind them. What do? I look for companies, and I actually have a screener I'm going to show you that does it for me. I look for companies that are just going to keep going sideways for a while, that pay out nice dividends, that the investors don't care so much. They rather just collect the dividends. They don't care so much if the stock goes up or down. Ericsson, you may or may not know this. You may think that they're the company that, used to make a brand of mobile phone. It turns out in every phone, whether it's an Android, a BlackBerry, a Microsoft phone, if it's an iPhone, they all have this little chip in them made by Ericsson. So Ericsson isn't going anywhere. GE, despite having all the breakups and all the things they make freaking turbine engines for airplanes. They make a little bit of everything for everybody. GE is not going anywhere. These are the type of boring companies that I like to sell premium against. So let me show you some trades on Ericsson I did. I'm going to show you one that gives you an idea of how we can sell a married protective option. But I'm also going to show you one about what happened in February when the market bottom fell out, when people started to get sick. So let's start here. This is a trade I did on Ericsson where I bought 1,100 shares. I paid $8.30. And then you can see about 2 weeks later, so this is what I'm talking about legging in. I like to leg in, buy the stock at as cheap a price I can, and then sell the option at as expensive price I can. So about 2 weeks later, I sold the option back for 20 cents. And at the same time, I bought myself a protective put. You can see here. I sold the Ericsson December 9 call, and I bought myself an Ericsson January 8 put. So I went about 2 months out. That's a little close in. Nowadays I like to go about 3 to 6 months out, but I bought myself a January 8 put. That means I'm protecting myself below $8, and I paid a nickel for that. Now, fast forward, let me spread this out a little bit so you can actually see what's going on here. Fast forward about a week, and that 20-cent option expired worthless. That means I got to keep the 20 cents. Then I waited for a bottom to be found, and I sold back my put. I bought the put on 12.17. I sold it back on 12.26. But look at the difference. I paid a nickel for my protective put. When I sold it out and rolled it out a month, I made 25 cents. So get this, because this is something that's unusual with this strategy that you usually don't do with covered calls. If people protect their position in covered calls, they usually, the protective put is a source of loss, right? It's just there for protection. But notice how we're using it as we leg in. Not only is it a source of protection while we own it, but it's also a second source of income. So not only are we making income on selling the premium, we're making income on rolling out our protective option. So I made 20 cents on the expiring premium. I made 20 cents on rolling out the option. And then I did it again the next month. The next month I sold another 20-cent. And then this time when I bought my protective option, it was a little more expensive. It wasn't a nickel, it was 20 cents, but that's fine. Same thing happened. It expired worthless. And when I sold that protective put out, I got it for 25 cents. This time I didn't make 20 cents, I made a nickel, but I still made money on rolling out the protective option. And then the next time I sold my premium for 50 cents, expired worthless, but I got exercised out at $9. After, what is it, 3 months, I wound up walking away with 23.9% ROI, 24%. But here's what I really want you to pay attention to. Notice what happened just after the first month of trading to the cost basis per share. And this actually, you can tell, includes what I pay for commissions. The cost basis went down below $8. In other words, my protection kicked in at 8. My cost basis was at $7.93 and went down from there. So think about that. What does that mean when your cost basis goes below what you're insuring the position to? This is actually the graph on Ericsson, that trade. Now I want you to notice this is the break even. And so in the first month, if the underlying symbol were to go against me, I'd suffer a tiny loss. Or if I got exercised, I would get a nice gain. But then what happened? Instead, it expired worthless. And so I did it again, and you'll notice this is where all of a sudden, if the underlying symbol goes against me, I still walk away with a little bit of reward. Again, if I get exercised, keeps going. And because the ROI is equal to profit over invested dollars, right, over your cost basis, notice that every cycle that I collect a premium, my cost basis goes down and I collect another profit on the way up. In fact, I collect 2 profits, don't I? I collect a profit from the premium expiring, and I also collect a profit from rolling out my put. Some of you who get an idea of what's going on, boom, your head's exploding. Some of you, maybe you don't, you'll have to watch the replay to really understand. But what happens is instead of gaining linearly, our returns compound. So I said most of our positions last about 5 months. What's nice about this is, a lot of people say, well, what's your win-loss ratio? For me, it doesn't matter, because if the underlying symbol goes against me, I almost make the same amount of returns as I do if it goes for me. Does everybody see that? How many with a show of hands see that? You really get an idea what I'm talking about here. You just let time do what it's going to do. You simply roll out the positions. It's about 2 or 3 transactions every month. And you want these things to last as long as possible. One of the coolest things ever. Like we said, we went out for 3 months and we wound up walking away with close to 25% ROI. Not bad. Okay, so let's keep going. I want to end this out. What do we have when our cost basis, in other words, our break-even price, is less than our protective bailout price? Do we have a risk-free investment? Do we have a losing trade? Do we have too much complexity? Do we have a pipe dream? Crack pipe? The answer is we have a risk-free investment. With this strategy, our investments become risk-free, usually after 1 or 2 cycles of selling premium. Okay, so I'd like you to write down these 3 steps. First of all, you're going to buy or short an underlying security, or even better, buy a substitute option that's trading at parity. Number 2, sell a near-term at-the-money option for its premium value, collect an instant dividend, and make yourself a profit buffer. And step 3, you're going to collar with a married option that is 3 to 6 months out in expiration to protect your investment. Now, I told you I'd show you the trade that happened in February, also on Ericsson. So as we know, here's the chart again. I'll go back to a year-long daily chart. This is what happened in February. Dropped down, of course. Most of the market did. So before that happened, on February 4th, I purchased 2,100 shares at $8.10. That was on February 4th. On February 20th, I sold 21 contracts of options at 30 cents a piece, and I bought 21 contracts of protective puts. Let's see what protective puts I actually, July. So I sold my March 9th calls, and I bought July 8 puts for 15 cents. Well, it wasn't long after February 20th where the market started to really take a nosedive. So nobody wanted to exercise my calls. My calls expired worthless on March 10th. I got to keep the 30 cents, in other words. And on March 10th, I went ahead and sold the underlying symbol that was crashing down. Now, I sold it for $7.40, and at this point, you might be saying, oh gosh, AJ, you took a bath. You paid $8.10. You got to keep the 30 cents, which dropped your cost basis to roughly $7.80 with commission $7.81. But you paid that 15 cents, so you're up at $7.97. Man, you lost 57 cents per share. Don't forget, I still have that protective put. And I waited. You can see here I waited until March 18th. March 18th is when we came to a calm at the bottom and started to work our way back up. That protective option that I bought for 15 cents, I sold for $1.95. At the end of only about a month and a half, I still walked away with 17.2% ROI. So like I said, these positions self-correct for anything that breaks out. Is that pretty cool? How many with a show of hands? That's pretty cool. So whether we're using those protective options and rolling them out and having them add incremental profits to our premium trades, or whether those protective options are actually bailing our butts out when things happen, we still wind up winning. Pretty cool. Here's how we leg in. So when we have a bottom, we buy the underlying, or we buy a call option trading at parity. We put a conditional bailout trade underneath us to protect ourselves. At the next top, we sell our near-term call option. We buy a 3 to 6 month output option as protection. That near-term call option expires worthless. At the next bottom, we sell back that 3 to 6 month output option, and we rinse and repeat, step 2 and 3 over and over again as many times as we can. Creates ourselves a monthly income. Now, if we wanted to come from the top, we didn't really talk about this tonight, but we should know it. We can short an underlying symbol that requires a margin account, or we can buy a put option trading at parity. That's a cash account trade. Put in a buy to close bailout for a risk at the top. At the bottom now, instead of selling a near-term call, we're going to sell a near-term put option, and we're going to protect it with a 3 to 6 month out call option. That put option will expire worthless. We'll sell back that call option and make a little profit. Rinse and repeat, rinse and repeat, rinse and repeat. As you see here, between each of these dotted lines is a month. So we're doing about 2 to 3 transactions a month. That's it. No day trading. Efficient trading. Write down these symbols. I want you to go look at GE. Also Teva. Teva Pharmaceuticals. New York Community Bank. My group just featured that today. Hewlett Packard. Nordstrom. Rite Aid. I'll give you a couple seconds to type that up. So at this point, I'd like to ask, how would you like to never miss a pick, minimize the amount of time you spend away from your loved ones doing what they like to do, and have hand-holding support whenever you need it? Because that's really what this is all about. It's about saving time, it's about creating clarity, and it's about getting results. So would it be okay if I take a couple of moments at the end of this presentation before I start answering the questions you've typed into the Q&A area to tell you a little bit about my materials, my training, and the tools I have to see if they might be a match for you? That's okay, raise your hand. Cool, thank you. So who's this for? Well, it's for someone who doesn't want to pay for all sorts of data subscriptions to all different sources. It's for people who want everything they need in one place. They don't want to miss an opportunity. They want to spend more time doing other things. That's critical. They don't want to learn how to do this alone. They want step-by-step instructions. In other words, this is someone who wants to get consistent, reliable results. Now ask yourself, is this you? Let me tell you about Charlene. Charlene's one of my favorite people. Charlene is a teacher. Now, teachers, especially public school teachers like Charlene, they are the most underrated folks I can think of. They take a lot of poop. They get paid very little. They take poop from their bosses. They take poop from the children's parents. They take poop from the children almost literally, if not figuratively. She had been a teacher for 29 years. She got sick. She didn't write it in her email, but she got cancer. And she was a trooper. She stayed in the classroom even through all the chemo and the radiation, to the point where she really couldn't even stay standing for very long. And so they finally ordered her out of the classroom. She still had 13 years left before she could get her pension. She actually thought she'd pass away, and she was pretty at peace with that idea. And this is where things, especially here in the States, kind of suck. She had a miraculous recovery. What does that mean here in the States? That means she lived, but she had a ton of medical bills. She had no livable retirement coming in. She wasn't going to be able to collect for 10 years on Social Security. So she got interested in the stock market, and the rest was history. She ran into me, and now she's not only going to be making a living, she's also going to be able to travel. She uses this tool that I'm going to show you called the Instant Income Calendar tool. All she does is read the daily table, find the stock that she's interested in, follows the strategy set out for her. She uses this along with some other strategies to diversify her financial plan. She recently made 14% just by spending 15 minutes reading about the company she was investing against, following the chart, and then waiting for expiration. It was easy. So if Charlene can do it, if my inner city kids can do it with their 4th grade education, even though the county says they're high school students, I know you guys can do it. So what is it you get? Well, I can go through these slides, but I'd rather just show you. So you get access to this cool web portal, right? Where you've got all these different menu things. The one thing I want to show you is the premium selling screener. This is a tool that we actually have the premium selling screener, the original one. It runs every night and it goes through about 13,000 stocks, ETFs, indexes, and it matches them with over, as you probably know, there's for every stock, there's hundreds of option chain. So last night it ran, or no, tonight it ran and it had over 1.2 million option chains. So it compares and it looks for where there might be premium. And so it finds them. It finds the best candidates for us to go research. Every night it runs. Now, again, we only need so many positions to fill our portfolio, on average 3 to 7 positions. So only 3 to 7 of these have to work. Buy this stock, sell this call, buy this put, return if exercise, return break even return, right? We also have some beta screeners that I've been working on over the years. This is a cool one, finding tickers. Each one of them works a different way. This is a program that is constantly getting improved, right? I mean, I've been running this program for premium selling since 2007. So we've got all sorts of benefits that we keep adding. We're about to add a cool service to this for those folks. After you've kind of learned how to do it, there's plenty of folks who want to walk away and go fish for themselves. And that's great. We give you everything you need to go do this program on your own. But there's a lot of people who'd rather just have me trade with them and for them. And so we're actually about to introduce, for those folks who go through this program, a recommendation service where you could actually just follow along, put your portfolio in with mine, and we'll actually do the recommendations and have you trade along with us. Kind of cool things. But the screeners are a big piece of this. The screeners give us what we need, but we also, there's the premium selling screener. We also have these cool Thursday webinars. By the way, check out this worksheet that we give you down here in the downloads section. If I go to the Learning Center and I go to the premium selling downloads and I download this premium selling worksheet, you fill in the blanks from whatever trading platform you use. If you use Charles Schwab, if you use Thinkorswim, if you use Interactive Brokers, you just answer these questions, right? Do you want to use protective options? What's the current cash value of your portfolio? What's the symbol we're interested in? You just fill them in by, look at what happens. Look at the bottom here. Covered call writing setup, covered put writing setup, bull call diagonal setup, bear put diagonal setup. It tells you exactly what to do. Go long 500 shares of New York's Community Bank after a bottom's been found for price lower than 1020. It gives you price targets. It tells you step by step, including making sure you're never going to risk more than your portfolio that you should. Remember, that was the #1 mistake people make. Covered put writing, short 400 shares, bull call. Go long 4 contracts of New York Community Bank, January 2022, $5 calls, right? How much easier can that be, right? We literally tell you step by step what to do. On Thursdays, we have a weekly workshop. We're having one tomorrow at 1 o'clock in the afternoon. We alternate. Next Thursday, it's going to be 9 p.m. then 1919. We like to cater to those folks in Europe and those folks to Asia as well, so that we don't have them staying up in the middle of the night every other week. During these workshops, we usually have about 100 folks, 150 folks, and we actually take the best pick of the week and we plan it out for you, right? Take a look. I'll show you. Come down here to where it says Premium Selling Workshop Replays. The last one we did was CHNG, the one before that, AMD. Let's look at CHNG. So here's the replay, the actual video. And then here's the cheat sheet so you can fill out your form and have it match us and get a plan. Then you can change the portfolio size. We used a sample size portfolio of $30,000, but maybe your portfolio is $10,000, right? So we actually, I call it learn while you earn. You come to the workshop or you watch the video replay, and we actually not only show you how to do it, but we give you a trade once a week to fill in your portfolio. Not bad, right? How many show of hands like this so far? Cool. I'm glad you do. So you get to be part of a once a week webinar workshop. Once a week, we go through, take you by the hand through an example of your choice so you can see how to set up, enter, manage, and exit. Repetition is king, plus we answer all your questions and we give you a setup. Also, this is the other coolest part. When you're ready to do one of these transactions, even if it's just in a paper trading log, you come up here to support. You click on ask a trading question. And what I want you to do, this is going to come directly to me. And that's why we have a limited number of seats open, because in the beginning, folks like to send me. I want you to send me, attach any screenshots you have. I want you to attach your trading plan, you know, this Excel worksheet. I just want you to attach it and send it to me and just say something like, AJ, I'd like to invest following the attached plan. Look it over, right? You send it to me and I'm going to look over your shoulder and make sure you're doing it right. And if not, I'm going to stop you and I'm going to say, hey, in other words, I'm going to trade with you. That's why I can offer this double your money back guarantee. So I want you to do this program. This program is 6 months. I want you to do this program with me. And if at the end of the 6 months you're not making profit, not only am I going to give you your money back for the program, I'm going to give you twice your money back. That's how confident I am that if you do everything that we tell you to do and you run your trades by me, that you're going to be successful. You're going to learn while you earn. All right, so you're probably wondering, how do I get this? And what is the price? So I want you to go right now to optioninvesting.org investor expos. Now I'm going to put this right into the chat box. So let me see if I can do that here. I've got it right here. I want you to follow this link. And I'm going to follow that link, right? It brings me to this page right here. If you get to that link and you go here, well, then you're at the right place. It tells you all about the program. It gives you some testimonials. Here's the scoop. I want you to do it for 6 months. The price is only $497. And don't forget, if you haven't made money after 6 months, I will literally pay you an additional $497. I won't just refund the cost of your access. I will refund every dollar of purchase and pay you $497 for your trouble. That's how confident I am that you can do this. So come on down. You can pay by credit card or PayPal. Don't pass go. Don't collect $200. You deserve this. And I feel like your loved ones deserve it too. If you have any sort of questions, you could always reach me at aj@tradingtrainer.com. That's my email address. This is my phone number going directly to my desk. And let's answer some of these questions that are in the Q&A. Do you give a trial period? Great question. The trial period is the 6-month program. Do the 6-month program. If it doesn't work for you, I'll give you double your money back. How often do you give trade alerts? Our scanner runs every evening. We'll give you a tested trade after every workshop once a week. But you're welcome to take the scanner picks and go and, do the vetting process. Well, all I ask is that on your first couple of trades, you pass them by me first. Let me look over your shoulder. Let me help you become an expert at this. And of course, like I said, at the end of the 6 months, if you want to join our team and actually get our recommendations, we're going to have that service up and running where we actually have you follow along with us in our investing and do it with us. Good question. Minimum account balance needed. We have some folks that have started with less than $1,000. Our smallest portfolio was $800. However, I'm going to be completely honest with you. If you can start with $4,000 or more, it's going to be easier for you because there'll be a lot more options open to your portfolio size, right? You're going to have to use some low priced, and you're going to have to use a lot of those substitute leaps instead of using the underlying stocks. So you could do it with a small portfolio of as little as, I would say, $800, but if you've got $4,000 or more, you're better off. Great question. Does this only work with covered call type trades? Somebody wasn't paying attention. That's okay, Michelle. We talked about 4 different types of trades: covered calls, covered puts, bull call diagonal debit spreads, and bear put diagonal debit spreads. The only one I featured here was the covered call and the bull call diagonal debit spreads. We have a whole bunch of other spreads that we haven't even reviewed in this presentation. It would have taken all night. Good question, though. Do you use implied volatility rank or implied volatility percentile? In our scanners, we do. So how do we earn while learning? Can you explain that again, please? Because if you come to the workshops every Thursday or you watch the workshop replays, we take you through the process of taking the trade of the week, the pick of the week, and planning it out to show exactly how to fill in that worksheet, this worksheet here, and how to get our own customized plan for our portfolio out of it. And then we give you in the replay page, as I showed you, the exact numbers to fill in on your worksheet so that you can go and do it. We give you the trade after we show you how we set it up. Are diagonal spreads included in the scanner package? Yes. Is it only for options? Ours is focused specifically on equity options, so we do stocks, ETFs, and indexes. Do you use implied? Okay, I already answered that. How does it work with E-Trade? Yes, it does. It works with any broker. We pride ourselves on being broker agnostic. Let me actually bring this back. This is the sheet that you should be getting to if you go to that order form. It's at optioninvesting.org/investor expos. So you should find 497 as your price. Make sure you understand what you're getting into. This may not be for everybody, but I bet you it's for a lot of you. It's one of the best webinars I've attended. Would it be possible to get a recorded version? Yes. By the way, thank you for that compliment. Um, I believe the folks at Investor Expos will be sending out a replay tomorrow. If not, I'll also be emailing out to a replay tomorrow. Robert says he likes it and he uses it. I think he's talking about these type of strategies. I came in late. Is there a recording available? Yes. Can you make it wider to see a whole column? I think he was talking about my trade log. So this is, let's see if we can make it wider. This is the trade that the underlying symbol bombed out against us, and we still wound up walking away after a month and a half with 17.2%. This is the trade that I did that shows what happens when your cost basis becomes less than your protective puts strike price. Are there any charges after the 6 months? No. In fact, after 6 months, I would feel that you are good enough to go out on your own. Now, I said there is 2 different branches. At the end of 6 months, if you want, you can totally go and fish for yourself and do this as many of our traders do. But we had a lot of demand from people who said, listen, I get it. I know how to do it, but I still am a very busy person. Can we just follow along with you? Now, I'm somebody who likes people to know what they're doing. And I understand that, you know, investing is not something that is a priority for many people, but I still want you to have an understanding of what you're doing. So I don't let anybody get our recommendations be part of our actual trade with us program until they've been through the 6-month program. So there is an option for those of you that do want to trade with us at the end. You're welcome to join us. However, if instead you'd like to just take off, there's no recurring charges. It's a one-time fee of $497. Here's one. How is it going to take me the full 6 months to learn how to do this? That depends on you. I would say that my fastest learner has picked this up, and this is somebody who had no trading experience whatsoever. They picked it up in 2 weeks. And how did they do that? Well, they binge watched a bunch of the workshop replays. They watched like 10 in a week's period, like 1 or 2 every night. My slowest learner took about 3 months. So then why is the program 6 months? Because I don't want you to just learn it. I want to be there when you actually do it. I want you to be doing it. I want you to learn while you earn. I want you to actually run your trades by me, send them through that support tab I showed you. And I want to give you advice. I want to be there as you start to do this, because investing to me is not something that you learn by watching a video or reading a book. You learn by doing. It's kind of like driving a car. You didn't learn how to drive a car by reading a book. You learned how to drive a car by getting behind the wheel of the car. And hopefully you had somebody, whether it was a parent or a driver's ed instructor or somebody sitting next to you, who could correct you when you were about to do something stupid. And that's what I want to be there for. So I don't want you to just get the knowledge. I want to be there as you repeat and build the experiences, and I want to be able to guide you. So that's why it's a 6-month program. And also, this is the exact program I use with my inner city kids, right? And so if they can do it, I know you can do it. All right. I trade full time. Is this good for me? I think that if you trade full time, you could totally do this in the background. In fact, you'd probably wind up after a while learning that you put most of your portfolio into these type of trades, and then the trading that you do full time, it's more for fun. You take like 10,000, 20,000 of your portfolio and trade it full time and let this work in the background and just double your money it turns out, and that's one statistic I didn't give you guys, people who are involved in my program, they're doubling their money right now every 4 to 5 months, not every year. Remember I said we aim for the moon, but we shoot for we wind up getting to the stars. So they aim to double their portfolio by earning 6% every month, but every year they double their portfolio every year. Turns out because they're earning closer to 11 to 13, 14, even 15% every month, they're doubling their money every 4 to 5 months. Do you also provide trade suggestion for overseas markets or just US markets? US markets. Is the scanner available after the 6 months? That it is available if you want to do the charge, but let me give you a little hint. This is Helena. Let me give you a little hint. I've been trading the same 20 symbols, plus or minus, say, 3 or 4 of them, since 1997. Once you find your candidates that have been going sideways, like Caterpillar is one that goes in and out of going sideways. You know, I've been trading Ericsson for almost 20 years. You won't need the scanner once your portfolio gets fully vested, right? You have a watch list, and I'll go through that with everybody. The scanner is good to get started because you have a lot of candidates, but once you've got your whole portfolio vested, you don't really need new candidates above and beyond, say, the 10 that you have on your watch list. But by all means, and that's why the sales team is not, you know, they don't like it when I do these presentations because I'm more honest. So just to make the sales team happy when they watch this recording, by all means, if you want to pay extra for the scanner after your 6 months, you're welcome to continue paying for the program. But in all honesty, you can walk away after 6 months and you'll be very successful on your own. Just depends on what you're looking for. What is the instant income calendar? That's the name of this program. It's my premium selling program. That's for DEAV, DEAV. I think that's your name. I do not live in the US, so how does that affect my trading status? Am I still eligible to trade US markets? Everybody's available to accessible to trade US markets. You just have to get yourself a trading account that allows you to trade US markets. That's all. Good question. Good question. Can you do you also provide trade? What's the instant income calendar? What is the expected gain I can achieve after the 6 months? I've already said that. My folks that are working on this are earning anywhere from about 11 to 13, 14%. Why do you have a lifetime membership for $19.97? Mark is asking. That's because some folks want to have access to all the scanners and screeners. Like I said, you could totally, at the end of 6 months, walk away and do this on your own, but some people just would rather have me do a lot of the stuff for them. And so if you want to sign up for lifetime right at the get-go, by all means, you'll have me for your life. I can look over your trades for life. You can take my scanner picks for life. You can take my Thursday setups for life. That's the reason why there is a lifetime. Helena says, what does the lifetime membership include, and is it available close to the end of the 6 months? Yes, yes, and yes. The only thing is, just so you know, and I'll bring this back, the lifetime offer, this is a discounted price. So you won't see this price again, $19.97. And that's $19.97 in addition to the $4.97. So you won't see that price again. That's just for folks who are ready. And I always tell people, if you're not ready to jump in with both feet, don't do lifetime now. But do know that the minute you pass this up now, the price is not that same. In fact, I told my marketing team I didn't want to offer it at this low a price, and they said, no, let's reward anybody who wants to do it right from the get-go. Because in my mind, being the founder of this company, I think that this is $4,000. So you won't see $19.97 again. So only take that option if you really want to. But just know that, yes, of course, the lifetime is available throughout the program, but you won't see that low price again. Good question, though. Chris asks, is this recorded? Yes. Where can I purchase your ebook? It doesn't appear to be on Amazon. No, you can buy the ebook directly from us. You can get yourself a free membership to our web portal, and you can buy it there. Why do you have? I do not live. Okay. What is the? Do you also provide trade? I think I've answered them all. Oh, I'm a total newbie. This is from Guido. I'm a total newbie without any knowledge of stocks, options, and ETFs. Can I do this? Absolutely. Absolutely. Again, wrap your head around it. I might ask you to go through some video trainings. I may ask you to have some strategy sessions with me where we get on the phone together. But like I said, if I can teach inner city kids with a 4th grade education in only a half an hour a day, I can teach you. Let's see what else. I think that I've answered all of the questions. Why is there a limit? Okay, this is coming from Mary. Why is there a limit? It says that you can only take 100 people. It's because I'm personally so hands-on that we like to close the doors until people have gotten to the point where they're confident enough that I'm not looking over their shoulder as much. That's a great question. So that's why we'll get enough people in at a time, and then we close the doors and we work with them. It usually takes about 2 to 3 months to get them up to speed. Then when we base when we do these type of presentations on what's AJ's bandwidth, right? Because I also have to do my own personal trading. Another question about somebody asked, what is the URL for the web portal? So all you have to do is go to tradingtrainer.com. You click on login, and it'll bring you to the web portal. And if you're not logged in, which you probably won't be, when you come, I'm logging out, so you'll come here and you'll notice that up at the top it says home, sign up, log in. So instead of log in, you click on sign up and it'll give you a chance to get yourself free access. You won't get any of the program that way, but you will get the ability to buy the ebook from within our web portal. More questions about what's the lifetime program? Again, the lifetime program is just access to have me supporting you, have access to all my screeners, be able to trade with us every Thursday versus going off on your own. Can the trades be taken in an IRA account? I did mention that in my presentation, but I'll mention it again. Any of the cash trades can be taken in your IRA account. In fact, most of us do that. Let's see if I can get you to the right slide where I said that. Maybe it'll jog your memory. Right here. You remember this slide? We talked about how we sell premium. We focus on 4 simple transactions: writing cover called, writing covered puts, writing covered calls against leaps, and writing covered puts against leaps. Those 3 that I have marked here as cash trades can totally be done in IRA. I agree, it is getting very late, but I want to make sure I answer everybody's questions. I hope how many of you, with a show of hands, are considering to be part of our program here? Excellent. Well, please take advantage of it. I see that actually, wow, we've already gotten 12 folks out of you. That's quite a large number of folks. I'm really thankful. That's really fantastic. Well, keep them coming. We can probably take, we did a presentation like this the other day, so we had, I think, something like 42 people join, so 12 more, that brings us up to 54. We're getting close to our limit, but keep them coming. Keep them coming. Do you have any last questions? that you'd like me to answer before we call it an evening? Oh, you want to see the URL again. Gotcha. The URL is, and it's in the chat box, by the way, but the URL is optioninvesting.org investor expos. Now, also you'll notice, maybe you won't notice. I'll leave it right there. Let's see what else. How long is this offer available? The offer is going to be available with the little bonus that we're going to give you, which is access to our accelerated learning program, probably until Sunday evening, but I'd take care of it earlier because if we hit our number, we'll just close the door on, we'll just close the door and not accept anymore. So it's kind of a first come, first serve basis. Somebody named John is asking, why not credit spreads? Credit spreads are margin trades. So we do debit spreads mainly because we like to do these in our IRA accounts. Good question, though. Best time to contact you from overseas? Just fill out a support ticket and we'll find a time. I can give you a link that allows you to schedule some time with me, and you just find a time in your schedule that matches my schedule. Will you teach option trading for a beginner? Absolutely. That's what we do. That's it. Folks, one last time, I thank you so much for your time this evening. You guys have been fantastic. How many of you, with a show of hands, picked up something new this evening you did not know before? Excellent. Let me ask another question. How many of you, with a show of hands, picked up something this evening, new or not, but now you have a much better idea how to wrap your head around it? Because that's what means the most to me. How many of you, with a show of hands, just plain old enjoyed yourself this evening? Fun. I'm getting a lot of comments about great presentation. Thank you so much. Thank you for your patience. I'll leave this screen up for now, but I'm going to go ahead and take off. Thank you, everybody. Have a good rest of your evening.